Thank you for joining me on today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra, and I want to increase your financial IQ with today's discussion about some recent economic data that has come out. To begin with, the Bureau of Labor Statistics, known as the BLS, in late October, this is 2025, came out with the CPI report. CPI is Consumer Price Index. It's basically a measure of inflation. So the annual inflation rate came in at 3%. That was less than forecasted. That's good news. On the somewhat negative side, the inflation rate still is above what the Federal Reserve has targeted, their desired rate, which is 2%. Inflation has been stubborn these last couple of years, but inflation is not runaway. It's stubborn, but not ruinous. It's not something that's really causing a lot of trouble in the economy. So markets have been confidently expecting the Federal Reserve to react to this news about inflation being higher than their desired rate, but somewhat in an okay range that would allow the Federal Reserve to cut interest rates. And that is what we saw. After the CPI report, the Federal Reserve cut the prime rate, interest rates that they control, by 0.25%. It's the second time in a row at a meeting the Federal Reserve had that they cut interest rates. The expectation is there'll be another one before the end of 2025. I'm a bit skeptical about that, but that is the consensus view, that we'll get another rate cut before the end of the year. Part of the reason why the Federal Reserve is cutting interest rates despite the stubborn inflation above their target rate is because the job market is showing signs of weakness. And the Federal Reserve has a dual mandate. Number one is that they want price stability, that is also known as low or modest inflation, and they want a healthy job market. So the dual mandate, there's a bit of a contradiction because they're a little worried on the inflation front, not freaked out, but a little worried. And they would probably be inclined to leave interest rates where they are. But the other mandate they have involving the job market indicates that cutting rates would be helpful to the economy and boost up perhaps the job market. So it's interesting as you dig into the inflation numbers a bit, some examples of things in the marketplace: apparel, clothes, up 0.7%. Smartphones declined 2.2%, and smartphones have dropped 14.9% year over year. That's a good news for consumers. Gardening and lawn services have seen almost a 14% increase. And if you think of that through the lens of what's happening with immigration and the administration's significant change in policy compared to the Biden administration, that kind of makes sense. That kind of jumped out at me, given what's happening on the immigration front with the closing of the border and stronger immigration policies, deporting lots of illegal immigrants or undocumented migrants out of the United States. Looking even deeper into the numbers, shelter costs, housing, is 1/3 of the CPI. That's up 3.6% annually. This is a pain point for Americans because housing is unaffordable. Home purchases for first-time home buyers, as a good example. For those renting, prices have gone up a lot over these bunch of years. So that continues to be a pain point, and a little disappointing that 3.6% increase in shelter costs is greater than the average CPI rate of 3%. So I think these numbers tell a pretty good story. We have modest inflation, although higher than what the Federal Reserve wants. They are in a little bit of a tricky position, the Federal Reserve, but they've decided to begin an interest rate cutting cycle. They've done 2 so far. They're likely to do some more, maybe again by the end of 2025 or perhaps moving into 2026. The economy generally is pretty good. Our mantra at Elliott Wealth Management Services this year has been that the trend is your friend. In terms of the economy and the markets, that we could see more of what the trend has been, which is stock markets generally moving higher and the U.S. economy generally moving ahead. We don't have third quarter GDP numbers as of this recording, but the expectation is that this will be the second quarter in a row where the economy grew at a pretty decent rate. So this scenario is probably pretty positive. Declining interest rates, manageable inflation, a job market that's weakening but not a disaster. I think the trend continues to be your friend. That's our base case here at Elliott Wealth Management. We will keep you apprised of our thoughts as they evolve, as data comes in, things change, things unfold. This is something that all of us here at Elliott Wealth Management watch very closely so that we could serve our clients as well as possible. So thanks for listening to today's episode of the Simply Financial Podcast. I will be back with you very soon with the next episode of the show. In the meantime, subscribe to the show if you haven't done so already. Maybe recommend it to a friend, coworker, family member. That would be terrific. Thanks again and have a great day.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.